Most people think they are looking at an oil crisis. I think they are looking at a sorting machine. That is the first thing I would want you to understand, because the way you name an event usually determines whether you make money from it or get trapped inside it. If you call this an oil crisis, your mind immediately runs toward panic. You imagine inflation, recession, governments losing control, consumers getting crushed, and the whole global economy slowing under the weight of more expensive energy. That is not wrong. It is simply incomplete. And incomplete thinking is what keeps ordinary investors on the wrong side of major transitions. I do not like incomplete thinking. I like asking a better question. Not what is happening. Who is it happening to? That is the real question. Because oil shocks never hit the world evenly. They never have the same barrel that feels like a tax in one country, feels like revenue in another. The same disruption that chokes one industrial system becomes bargaining power somewhere else. The same fear that empties one portfolio can quietly enrich another. That is why I say this is not merely an oil crisis. It is a sorting machine. It is taking the global economy and separating price takers from price setters, import dependency from domestic production, fragile energy users from energy suppliers, and headline thinkers from map readers. That is the distinction that matters. Most people still think about oil shocks as if we were living in the old map. In the old map, the United States was heavily dependent on imported oil. A major supply disruption in the Middle East moved through the American economy like a hammer. Prices rose, inflation accelerated, confidence fell, and the entire system took the hit in a fairly direct line. The country consuming the shock was the country everybody assumed would suffer from it. That map is outdated, and a great many investors are still drawing strategy from an outdated map. That is a dangerous habit. The world has changed in a very important way. Over the last 2 decades, the United States stopped being primarily a large, nervous customer in the global energy market and became something else entirely. It became a dominant producer. That changes the geometry of the event. A shock that once hit America like a supply crisis now hits it more like a pricing event. That does not mean the pain disappears. Higher oil prices still move through transportation, food, chemicals, manufacturing, and expectations. They still squeeze. They still create inflation pressure. They still hurt households and raise political costs. But that is not the same thing as losing direct access to the energy artery itself. That difference is enormous. This is where I want you to stop thinking like a citizen reading headlines and start thinking like an allocator reading pressure maps. The Strait of Hormuz is not just a narrow strip of water. It is a financial sorting gate. Roughly 1/5 of the world's oil moves through it. That makes it the most important energy choke point on Earth. But a choke point matters less in the abstract than in relation to where the flow is going. That is the part almost nobody explains properly. Most of the oil moving through that channel is not headed to the United States. Only a very small share is. The real dependence sits elsewhere, overwhelmingly in Asia, and more specifically in countries like China, India, Japan, and South Korea. Those economies are the ones leaning on that passage as if it were an extension of their industrial bloodstream. Once you understand that, the whole story changes. You stop asking whether the shock is big. Of course it is big. You start asking, who absorbs it in the worst possible form? That is what I call the burden split. The burden split is the first mechanism in this story. An oil shock does not arrive as one universal problem. It arrives as different kinds of pain depending on the structure of the economy receiving it. For the United States, the problem is primarily price for heavily import-dependent Asian economies. The problem is price and supply. Those are not cousins. They are different species. A price problem can be managed, though not pleasantly. It shows up in inflation data, margins, consumer behavior, and political anger. It is real. But a supply problem is more dangerous. A supply problem gets into the actual ability of an industrial system to run. Factories slow, energy gets rationed, inputs become harder to secure, planning horizons compress, governments start behaving differently because the issue is no longer what energy costs, but whether enough arrives. That is the real asymmetry. One country feels the same event as a more expensive world. Another feels it as a more constrained world. A constrained world is much more dangerous than an expensive one. That is why I do not read this event as a symmetric macro scare. I read it as an asymmetric energy tax with a highly political distribution of pain. That leads to the second mechanism. I call it the producer flip. The producer flip happens when a nation that used to suffer primarily as a buyer now begins benefiting as a supplier. This is one of the most important changes in the global economy, and yet most commentary still treats it as if it were a footnote. It is not a footnote. It is the core of the new map. The United States is now the largest oil producer in the world. That simple fact means the same oil shock that once would have been a straight negative for the American system now has a split personality. It hurts consumers at the pump and through inflation, yes, but it also boosts revenue, margins, and strategic leverage for producers, exporters, service firms, pipelines, and energy-linked sectors that suddenly become much more valuable in a tighter world. The point is not that America becomes immune. Immunity is a childish concept in economics. The point is that the country is no longer standing on the same side of the trade it once stood on. That matters immensely. A nation standing on the production side of a higher price regime does not experience the same macro story as a nation stranded on the import side. This is why I always insist that investors separate the national narrative from the sector narrative. People hear higher oil and imagine one giant negative. That is what headline thinking does. It smooths the world into a single emotion. But markets do not pay for emotions. Markets pay for structure. If scarcity lifts realized pricing for domestic production, then parts of the U.S. economy are being stimulated by the same event that is creating pain elsewhere. It is the same shock but not the same profit and loss statement. That is why I keep saying this is a sorting machine. It is sorting consumers of energy from owners of energy. Now let us add the third mechanism, because oil is only half the story and most people never get far enough to notice the other half. I call it the gas mirror. The gas mirror matters because natural gas, especially liquefied natural gas, reveals the same asymmetry all over again. But in a cleaner, even more underappreciated form, the Middle East is not only a major oil exporter, it is also a critical exporter of LNG, and a large portion of that LNG flows through the same narrow corridor. Qatar and the United Arab Emirates rely heavily on that route. If Hormuz tightens, it is not just crude that becomes scarce. Gas markets feel it too. Now ask the same question we asked with oil. Who loses supply? Who gains pricing power? And once again, the map points to the United States. America has quietly become the largest LNG exporter in the world. That means when one region faces disruption, another region is sitting in position to sell into the gap. The crowd sees crisis. The allocator sees market share being reassigned by geography and infrastructure. This is why certain energy exporters and LNG-linked businesses can rise sharply, while the public keeps repeating that an energy crisis must be universally bad. Scarcity is not universally bad. Scarcity is a transfer mechanism. It transfers power to whoever can still deliver. That is the gas mirror. The same story reflected through a different fuel. I have always believed that the best investing opportunities come when people are still emotionally trapped inside the first layer of the story. They hear crisis and stop. They hear volatility and stop. They hear Middle East and stop. But the real money is almost always made in the second layer, where you stop asking whether something is scary and start asking whether it is uneven. Unevenness is where the advantage lives. That takes us to the fourth mechanism. I call it the reserve illusion. China is the clearest example here because China is the biggest potential loser in this specific setup, but not in the simple way most commentary describes it. People who think in cartoon terms imagine China as helplessly exposed, as if it had ignored this possibility and built no buffers. That is not true. China saw the risk years ago. It diversified suppliers. It increased imports from Russia, Brazil, and Venezuela. It built reserves. It prepared to some degree, just as any serious power would. But buffers are not the same thing as immunity. This is what I mean by the reserve illusion. Reserves buy time. They do not erase dependence. Alternative suppliers reduce concentration. They do not erase scale. And scale is the key word in China's case. China is the largest importer of oil in the world. It runs on energy, not in the abstract, but in the literal industrial sense. Manufacturing, export machinery, steel, transport, chemicals, heavy industry. The whole engine depends on continuous inflow. So when you have a country with gigantic energy appetite, partial hedges help, but only for a while. That is the crucial timeline distinction. In the short term, reserves absorb the shock. In the medium term, reserves are drawn down and alternative flows are leaned on harder. In the longer term, if disruption persists, the issue stops being whether the country planned well enough and becomes whether the industrial system can keep running with the same confidence and scale. That is when an inconvenience becomes a structural problem. And structural problems are what matter in geopolitics because they change bargaining posture. Which brings me to the fifth mechanism. I call it the leverage conversion. This is where the story stops being about energy in the narrow sense and becomes something much larger. The timing of this Hormuz stress is too interesting to ignore. The world's two largest powers have already been moving through a period of trade friction, technology restrictions, tariff escalation, supply, chain distrust, and strategic decoupling. The financial and geopolitical relationship between the United States and China has been steadily hardening into something less cooperative and more coercive. Now place an asymmetric energy shock on top of that. If one side of that rivalry can tolerate the shock better than the other, then the shock itself becomes a form of leverage. Not because somebody has to declare it openly, because systems under pressure negotiate differently than systems with room to breathe. That is the leverage conversion. A choke point starts as a transport risk and ends as a geopolitical bargaining chip. The Strait of Hormuz is not only a channel for crude and LNG. Under the right conditions, it becomes a channel through which pressure is translated into negotiating power. This is why I do not accept the simple story that we are just watching an oil crisis unfold. No, we are watching energy geography get converted into strategic leverage at a moment when the larger rivalry between the United States and China is already primed for exactly that kind of pressure. Most people dislike this kind of framing because it sounds too cold. Good power is cold. The world does not run on the emotional preferences of commentators. It runs on bottlenecks, dependencies, incentives, and who can absorb pain longer. That is what strategic investors must understand. Now, once you see these five mechanisms together, the picture clarifies. The burden split tells you this shock is not symmetrical. The producer flip tells you the United States is no longer standing where it once stood. The gas mirror shows you the same asymmetry reappearing in LNG. The reserve illusion tells you China's preparations buy time, but do not remove structural exposure. The leverage conversion reveals why this is not merely an energy event, but a power event. Once you understand that, you can stop thinking like a frightened observer and start thinking like a buyer. That identity shift matters, from headline follower to map reader, from panic interpreter to positioning allocator. That is what separates people who merely survive volatility from people who use it. So what would I do with that understanding? The first thing I would do is reject the emotional temptation to treat every energy price spike as a broad anti-risk signal. That is the reflex of people still living in the old map. Instead, I would ask where the revenue accrues when the world tightens. If a crisis raises the price of what you produce, and you happen to be one of the few large systems that can still produce it at scale, you are not simply in trouble. Parts of you are being paid. That does not mean I buy anything with energy in the name. That would be foolish. It means I look for durable exporters, LNG, linked players, pipelines, infrastructure, and the kinds of businesses that actually convert global scarcity into domestic cash flow. The second thing I would do is increase my skepticism toward heavily energy dependent industrial exposures in places where supply dependence is not a short-term headline issue, but a structural vulnerability. Not because those economies are doomed, because their margin for error is thinner. The third thing I would do is keep asking who has optionality. Optionality is one of the most beautiful forms of wealth because it lets you behave calmly when the world gets unbalanced. America, in this new energy map, has more optionality than the old narrative grants. It has production, it has LNG export capacity, it has domestic winners that profit under the very conditions that stress its rivals. That is what makes the situation secretly good in certain respects. Not good in the sentimental sense, good in the strategic sense. This is a critical distinction people need to learn. A shock can be socially painful and strategically useful at the same time. A rise in prices can be politically ugly and profitably asymmetric at the same time. A crisis can hurt households and still increase national leverage at the same time. That is how the real world works. The emotional mind hates this because it wants clean categories. Good or bad, safe or dangerous, bullish or bearish. Those are the categories of people who want certainty more than accuracy. I would rather have accuracy. Accuracy begins by admitting that the same event can produce opposite effects depending on where you sit. That is why energy shocks create both losers and winners. They punish import dependence and reward supply ownership. They expose outdated narratives and enrich those who notice the map changed first. Now, let me say something directly to the person who still thinks this is all too abstract. You do not need to predict the entire geopolitical outcome to profit from the structure. That is another amateur mistake. They think they need to know how the war ends, how the negotiations end, what exact week supply normalizes, or which leader blinks first. No, you do not get paid for clairvoyance. You get paid for understanding asymmetry before the crowd does. If the United States is less directly dependent on Hormuz than Asia is, that matters. If U.S. oil and LNG exporters gain from global scarcity, that matters. If China's industrial machine is more exposed to prolonged disruption than the market narrative fully appreciates, that matters. If a choke point can function as geopolitical leverage in the middle of a broader strategic competition, that matters. You do not need to know the final chapter to know what the middle chapters are doing to prices. That is enough. I think this is where Buffett-style thinking helps the most. Not because I have some magic forecasting skill, but because I have spent my life trying to simplify complex situations into one or two dominant economic truths. The dominant truth here is that the world changed sides of the energy trade, and a great many investors did not update their mental map. That is why the opportunity. The second dominant truth is that bottlenecks create pricing power, and pricing power is one of the purest drivers of wealth in any system. Who owns the bottleneck? Who owns the supply? Who can still deliver into scarcity? Those are the right questions. Everything else is noise until those are answered. Let me take the whole thing one step further. The old story said Middle East instability eventually hurts the United States because the U.S. is downstream from imported energy. The new story is different. Middle East instability now acts more like a tax on America's rivals and a revenue event for parts of America's domestic production base. That is an enormous strategic reversal. It means the same shock that once would have been interpreted as broadly anti-American can now be partially pro-American in a narrow but important economic sense. That is not a moral statement. It is a map statement. And a map statement is often more valuable than a moral statement because capital flows on maps, not sermons. By the time the public updates to the new map, the best positioning is usually already behind you. That is why I keep insisting that this is really a story about positioning. Not because positioning sounds sophisticated, because positioning is where the money is made. You can have the right opinion about the crisis and still make nothing if you stand in the wrong place. You can have the wrong emotional reaction to the headlines and still lose, even if the broad thesis sounded intelligent. Where you stand matters in this case, standing with domestic energy leverage, LNG optionality. And the new asymmetry of the American energy map makes much more sense to me than standing with the outdated belief that every oil shock necessarily hurts the United States in the same way it once did. The world moved. The map moved. The pipelines, export terminals, shale fields, reserves, and industrial dependencies moved. You are trading ghosts. And trading ghosts is how smart people go broke in periods of structural transition. I would rather trade the real geography. I would rather trade the actual flow. I would rather trade the imbalance between import dependence and production power. I would rather trade the pressure difference between countries that can absorb the shock and countries that can only delay it. That is the real edge. Now, I want to end where I began. Most people think they are watching an oil crisis. I think they are watching a sorting machine. A sorting machine dividing the world into exposed and buffered buyers and sellers, consumers and producers, map readers and headline repeaters. Once you see that, the situation becomes far less mysterious. The question is no longer, is this crisis bad? The question becomes, bad for whom, good for whom, and who gets leverage from the difference. That is how you should think. And if you do, then what looks like chaos to everyone else begins to look like something much more valuable. An asymmetric opportunity hiding inside a very noisy story, that is where I would rather be. Not in the crowd repeating the old narrative, on the new map, standing where the flow turns into power.